Good morning, everybody. My name is Lucas Sjostrom, Executive Director at Minnesota Milk, and we'd like to welcome you to this broadcast. We're just starting up, and Dr. Bozic is queuing up his slides, but just so you know how this is going to go today, we'll have a number of polls throughout, so we'll be able to fire those up as we go. We've got 263 of you, 275 by the way it looks, online, so we'll try to take it slow because I know bandwidth has been a problem. YouTube actually slowed down all of their videos, took them off HD this week, so that's how big of a internet surge there has been. So as Dr. Bozic comes on board, just want to say Minnesota Milk is a membership organization in Minnesota. I know we have people from across the country. We represent well over half of the milk in our state, but it's a voluntary membership organization, and it's 1 penny per hundredweight for us to do our work, mostly at our state capital in St. Paul, but also at the federal capital in Washington, D.C. So I'll just comment here. We've been in touch with D.C. this morning with our federal officials, and it's looking like this latest bill had a chance to have some dairy information in it, but it will not have any dairy information, and dairy bills this time around. But we're expecting things like production history updates and production history updates and potentially going to enroll everybody in dairy margin coverage will be up for debate in future versions of the COVID-19 funding. So if you have questions, please do enter them in on the side, and we will be sure to answer them as we go. I saw a few people had kind of simple questions as to whether they were on the right webinar or not, and yes, we're starting up here shortly. So we'll wait a couple minutes as people get on and then get going. I'd like to thank Jenna Davis and Morgan Kraus from our staff for helping us out, and if there is any background noise, it'll be mostly Marin talking, but myself as well. Apologize for any children that we have involved by accident in the broadcast. So just give us a couple minutes for people to get on and we'll get rolling. And I think we're about ready to go. Dr. Bozic, are you there?
Almost there.
Thank you, Marin. And we were literally filling slides with information this morning as we were getting the latest information out of Washington. So that's part of the delay. These are hot off the press. So hopefully you can see your slides there. It looks like most people have it up. It's a little bit delayed in some parts of the country. We've got kind of a monitor here. But also want to mention I-29 MU University as our co-sponsor through this. That is the different universities and their affiliated extension in the states, as you see there, North Dakota, South Dakota, Nebraska, Iowa, and Minnesota. So Dr. Bozic, I'll chime in. You don't seem to mind when I step on your toes once in a while. Otherwise, feel free to go. And thanks so much for joining us today. And I was asking you before, you don't have a hard stop at 1 o'clock, do you? We can be on for questions, or when do you need to go?
No, I'm flexible, so we can stay until we answer all the questions. You know, this is a pretty important event, and we're in unprecedented times, so we'll make sure that we answer it. First, Lucas, you hear me well? You see me and you see the screen, correct?
Yes. Yep. Go ahead.
All right. Thank you. Let me. Okay. Well, first of all, thank you to Minnesota Milk and the I-29 MU University for organizing this event. We have quite a few people attending. I think over 350 right now, and I think some more may join us. You know, the topic is really important, and the times are really unprecedented, at least in recent history. But I'm mindful of Gettysburg Address. You know, it had only 200 words plus, and here we are, hundreds of years later, still reciting it and finding it pithy and appropriate for the occasion. So I'm not going to talk for a full hour. On a typical Outlook, we go through supply and demand and this and that and so many different details. I want to focus on one issue and print upon you the most critical action item that you can do right now, and then leave it at that, because I really want to that to sink in, and I really do want you to act. Then we'll open it for Q&A, and we'll go through whatever people are interested in discussing. Okay, so you've heard the concept of black swan a lot these days. So an event that comes as a surprise has a major effect, and is often inappropriately rationalized after the fact, once you have the benefit of a hindsight. The coronavirus outbreak really can be classified as a black swan event. Yes, there have been papers as early as 2015 among doctors and scientists that study viruses that argue that bat population harbors viruses that could easily transfer to humans. And yes, there have been papers in the literature for years now worrying that we don't have enough ventilators in case of an outbreak and etc. But still, up until very recently, this was not on our radar screen. I gave an Outlook talk in the Dairy Strong conference in Wisconsin in late January, and my message was 2020 is going to be a good year, time to rebuild your equity, to pack up for the decade ahead of us, to make some strategic decisions, etc. And here we are 2 months later, and the world in which we live in is unrecognizable. I'm looking here through the window of my home office. The streets are empty. There are no kids playing, and it looks a little bit like those Hollywood movies, in which the plot suddenly becomes science fiction. So what do we do, and how has this affected our economy so far? Well, here's the Dow Jones Index, which measures the 30 largest stocks, not the largest, but the 30 bellwether stocks for U.S. economy. And then you can see before March, typical oscillations would be 1% down, 1% up. It was a major event when Dow goes 600 points up, or something like that. And then look what happened in March. Some of the biggest drops that have ever been recorded, and also some of the biggest rallies that have ever been recorded. The rally yesterday in Dow Jones was over 11%. I have here on the slide through noon, 8.9%, but 11% by the end of the day. That didn't happen in 87 years. And who knows what tomorrow will bring to the market. So at the same time, we have a rapid rise in whole new industry of memes. So that not everything is so bleak. I know it's a serious situation, but we still have to keep our spirits up. So Throwback Thursday here, a recent meme with the toilet paper, and then on the right side it says, after 2 weeks of quarantine, Gertrude has decided to knit her husband a scarf there. So more things like that. But it's not a laughing matter. Like I want to show you what happened in dairy. First, retail. Retail is a good story for us here. Fluid milk volume up 33%. That's the week ending on 15th of March versus a year ago. Thank you to Dairy Checo for procuring this data from IRI Nielsen and making it publicly available. They usually publish this data once a month. But now, due to these circumstances, I understand we will be getting this report week by week. Of course, what we all want to know is whether this is a one-off event. 1 week went up, and then people now will be destocking, depleting their inventories of dairy products that they have at home. Or are we in a new demand regime where people have pulled off from eating outside and cooking more at home and eating more comfort food perhaps as well? We do know when people feel emotionally traumatized that ice cream helps as well, for example. So we see fluid milk up 33%. We see shelf-stable milk. An example is Fairlife, up 64%, and in some areas more than double. For example, New York, which is currently the epicenter of the epidemic here in the United States. Butter up 85%, and cheese up 62% that week versus a year ago. So that's all good. Unfortunately, that's not the only thing that's happening. The food service industry is down, and down badly, not just in the United States, but also globally here. So I have two charts, one from Statista, the other one from FC Stone. I did not have time to ask for permission, but I hope that they will see that as a free advertisement rather than a plagiarism. I very much appreciate the work that Nate Donna is doing at FC Stone, one of my favorite area analysts. So what we see is that the restaurant industry is suffering globally. And the way you read this chart is that when it's zero, that means that it's as good as the year before. And then when it goes down, that means that it's a reduction in bookings for tables in restaurants versus year ago. Germany, United Kingdom, United States, globally, where everything is down, everything is closed. The world has closed down, essentially. What does that mean for dairy? Well, the best estimates we have is that about 30% of milk solids is consumed through food service. Now, you have two effects there. First, people are not eating outside in restaurants, but they're cooking more at home, and they're also having meals delivered to their home. So I spoke with folks that make pizza, cheese, mozzarella, and they say that pizza deliveries are doing really well, and their sales have been going well as well. Overall, analysts currently anticipate that the drop versus what was forecasted at the beginning of the year is anywhere in the range of $1 to maybe $3 for class 4 and class 3 as well, the mix between them. That's given current information that can prove to be either too benign or not harsh enough relative to what will actually happen. But that's where we are right now. And what I want to do is I want to take you through some screenshots from the risk management tool that is available through your local Farm Credit Association. So here it is. This is the quarterly average class 3 and class 4 price for January, March 2020. And I want to show you how they evolved over time. So class 3 had a peak just as that quarter was going off sale for dairy revenue protection at over $18, and we are now down to $16.77 for the quarter. That's not March, that's January, February, March. So that 2 out of 3 months were barely affected because the outbreak really happened in the late February and then into March. For class 4, we have been going down for a variety of reasons. Once we saw the China outbreak and also the developments in the world milk market. So it is down about $2 versus the peak in December, even the first quarter of the year. And then the second quarter is showing even deeper declines. This is April, June 2020. And you can see there that class 3 is down from a peak of 1788 in late January. January 24th was the contract high at 1788. We are now to 1552. So that's over $2.30 down for April, June 2020. And then for class 4, we were as high as 1750 or more, and now we are down to 1384 as of yesterday for the second quarter of the year. So markets is anticipating that the prices will not recover next week. This is going to go on for a while. In fact, when you look at the second quarter of next year, in class 3 markets, the drop has not been as precipitous just yet. So the contract high happened on February 19, 2020 at $17.11. We are now down to $16.26, so that's what, 90 cents down, or so 90 cents down. Not as much as we've seen for the second quarter of 2020. In class 4, up until very, very recently, up until just a few days ago, you could lock in a really decent price over 17 bucks. We are now down to $16, and who knows what tomorrow brings. That's really unclear. Then I want to show you a little bit what's available for Minnesota. This is easily replicable for other states. So what I did here is I used the mailbox milk price for last 3 years, and also the Federal Order 30 butterfat and protein test. So I built a representative dairy farm in Minnesota because I wanted to see the basis. This is not to say that the basis forecast is that this is the foolproof basis forecast going forward, but at least it's somewhat informative of what to expect, assuming that there'll be no dumping. So what we see as of yesterday, I believe, that the expected revenue floor that you can lock in for Minnesota right now for the from July this year all the way through June of 2021 is anywhere between $16.30 and $17 for the fourth quarter of the year. Revenue floor, again, is the revenue guarantee minus the premium, and then add the basis back in. So I see that there's a poll open. Lucas, did you want me to stop here and ask people to do a poll, or?
Yeah, I think I kind of accidentally pushed the button, but kind of on purpose. So sorry about that. But as you can see, how many months of class 3-4 prices below $14 can you sustain? And I just wanted to stop because we're getting a couple messages that people can't see the slides. If you're on a mobile device, you can swipe left or right to switch between Marin's video and the slideshow. If you're on a computer, you should be able to see it. And somebody also mentioned that they can't hear you anymore, but I've only heard that from one person. So I'm sorry. I would recommend you call in by phone. And if you need help doing that, please send another message.
Okay, so how many months of class 3 and 4 below $14 can you sustain? We see that about a quarter are saying 1 to 2 months, 30% are saying 3 to 4 months, about a quarter are saying 0 months, and then 5 months or more would be over 20%. A plain summary would be that we had, other than the last part of previous year, we had several years in a row of really miserable prices, and folks' ability to sustain shocks and ride out bad times has been jeopardized by that period. So in addition to dairy RP, we are, of course, the dairy industry is asking the government to intervene and help save the day. Here, I just saw the bill 10 minutes literally before jumping on a webinar. There have been three requests from dairy. First is that the DMC, dairy margin coverage for 2020, be reopened. That is unclear if it will happen. The Office of the Secretary of USDA did get almost $10 billion that they can spend at their discretion. And they can spend some of that money. It's my understanding, but it's very, very new. So I apologize if I'm misinforming you, but it's my understanding that they can decide to reopen it if they so wish to do that. But the money is not encumbered for that. It will be now a battle of sorts, between commodities on who can argue the best where that money should be spent. Also, there was another request to do an upgrade of production history. You may recall that the production history for dairy margin coverage is based on the highest of 2011, 12, and 13, plus of those small annual increments. Representative Emmer introduced that bill, I believe, 2 weeks ago, and then it was at one point in the draft of the stimulus bill on the House side. In the final version, it's my understanding that it did not survive. They wanted to keep the program focused on on only those activities that can be clearly explained as emergency measures. So short-term emergency measures, this would be a permanent change as it was originally proposed. So that did not get through, that did not get forward. And then the third request from the industry was to do more intervention purchases. And there is money for that. Now the USDA needs to act, and more on that later. So back to my slide here on what you can cover for Minnesota. We are looking between $16.30 and $17 once you account for the basis. And again, this is historical basis. If you believe that your basis going forward is going to be lower or higher, you could, if you're working with your local farm credit, from coast to coast, anywhere, not just in Minnesota. If you're working with your local farm credit, you should be able to use this and make some decisions for you. Like this is the tool that I helped build for them, and my hope was that every farmer in the United States will, no matter if they have 50 cows or 10,000 cows, that everybody can get a good tool in their hands to make meaningful decisions. So it's not a university project, unfortunately. It takes a whole lot of money to build a software product like this, but I did want to serve the public by making something available from coast to coast and for all dairy farmers. This is what I really want to talk about. If you're going to remember one thing from today, I hope it's not that meme with Gertrude knitting a scarf. I hope this is the slide, and the next slide is what you take from this webinar. In normal times, this is not normal time, but in normal times, a way to think about, in my opinion, the best way to think about dairy risk management is to use with dairy revenue protection, is to use the last 2 quarters for a break-even protection. So you basically, you look on the board, if you see the price that once you correct for basis, etc., you get a floor that allows you to break even, you take it, you snatch it. You keep still all the upside, but you cover your downside. You won't lose money. And then if you don't find a price that's good for you, as you approach the month that you still don't have protected, 2 to 3 quarters out, then you go into loss mitigation mode. Basically what you're saying, okay, I cannot reasonably hope anymore that I will have always the ability to cover my break even. But maybe prices are already low enough, but I am going to still cover it so that I don't lose my pants if I have to lose $1, right? So that you don't lose so much that you lose your farm in the end. So, and for the first 2 quarters, when you look at the prices through DRP or CME, etc., it's not about whether you can cover your break even. It's about whether you can put a limit to how much money you will lose if times are already bad. But like you start early and you wait, and you look at those distant months to see whether you can cover your break even. So you start early, but you look for break even, and then in front months you either look to limit your losses, or maybe if prices are really high, you look to lock some profits. And then so how does that work? How did that work historically? If you were consistently using the most distant quarter, what you would find is that your indemnities would have been clustered. So you see on the chart here that 2009, there would be 6 quarters in a row where you would get an indemnity, then a few years of nothing, and then 2015, 2016, again, 4 quarters of indemnities back to back, and then in 2018, again, 5 quarters of indemnities back to back. Out of 47 quarters in this sample here, 17 would have paid out, so just over a third. And then the average payment per hundredweight would have been 73 cents. 73 cents over this 12-year period here. Not quite 12-year, yeah, 12-year period. Okay, but if you were, and this is dollar amount if you were doing it for 1 million pounds per quarter. If you were always hedging the front quarter, what you would find is first, your average payment per hundredweight would have been lower, so down from 70 down to 54 cents, and your payments would have been sprinkled out over time. Overall, you would not see more quarters pay out. So 16 quarters would pay out here in the nearby strategy versus 17 in the distance. So you won't get more quarters paying out. It's just that they will be sprinkled around as opposed to clustered. Clustered works better because cluster gives you more money in times when you have prolonged deep slump like we're about to have now with COVID-19. We had that back in 2009. A good example, if we had DRP sometimes from 2007 onwards, and if you had always hedged those fifth quarter out, 2009 would have been a fine year. You would have received $3-4 per hundredweight indemnities for four or five consecutive quarters. It would have been a fine year. In fact, the maximum payment was $7 per hundredweight in one of the quarters back in 2009. Okay, so that's all for normal times. That's my point. Let me see. Here. So that's all for normal times. Back quarters for break-even protection. And then if you don't get it, if you are not able to find a price that works for your break-even as you approach that month, you have to change your mindset and you have to accept that you may have some losses, but you still need to put a floor so that your losses don't mount, so that they're not too high. That's for normal times. How does this change when we are in these unprecedented times as we have right now? Well, first, the April ahead of us is going to be, something that we likely haven't seen in our lifetime. So the picture here on your left this is from a hospital in Spain taken just a few days ago, where they don't even have enough beds, let alone ventilators. So the COVID-19 patients are being put on the floor with just a blanket beneath them. I hope we don't reach such situation in the United States, but we are currently on a trajectory that our deaths from COVID-19 are increasing exponentially. So this is a logarithmic scale. Here on the right side, you can see that it's a straight line when you make this a log scale. What does log scale mean? That means that every time you jump from line to line, you go up 10 times. So the difference here is from 1 to 10. This difference here is from 10 to 100. This difference here is from 100 to 1,000. Difference here is from 1,000 to 10,000. This is deaths by day. At some point, it's going to slow down, but it is going to get worse before it gets better. And April is likely going to be a harrowing month for all of us in the United States. And it's going to, what's going to be particularly painful about it is that we're at the same time when a lot of our fellow citizens are dying, we will also have a much necessary debate on when do we reopen the economy. And there seems to be a split between the Democrats and Republicans among people in their level of concern regarding COVID-19. And there seems to be a difference in what our current president, what a past president suggests be done soon. President Trump would like to reopen the economy by Easter. Former President Obama is saying, well, no, like let's stay under lockdown. Here's a pretty cruel, but I think that an accurate way to summarize the debate. This is not me trying to say that this is the proper way to say it. I think that this is the debate that we are having. In normal times, statistical value of life is about $7 to $9 million, meaning that the amount of cost that you would incur to avoid losing your life would be about $7 to $9 million as a society. But how much is one life worth when 30% of the population is unemployed? When you're unemployed and you live paycheck to paycheck, you're stressed out. Maybe you get a heart attack. Maybe you get evicted. Maybe you don't have money for medicine. So you if you had any pre-existing conditions, they worsen up. So it's pretty bad. We are going to see unemployment of 30% here coming up shortly, and we will have to have that debate. At which point do we say, okay, we understand that if we start moving around again and reopening the economy, that more people will die, but still the costs of not doing that outweigh the benefits. So the benefits of reopening the economy outweigh the costs of doing that. It's a terrible debate to have. it's something that you never hope to have to engage in, but it started already. And in fact, on my Facebook feed, I see some very wise and successful dairymen already writing about this in a very well argued way, that we need to reopen the economy. There are some promising new treatments that are now currently being tested. We all hope that this is going to be done very soon, but we may have to make some difficult decisions here. So the poll is in progress. I don't see the question. Have you had any flu symptoms since January, even if you did not get tested?
Yeah, and for those who hopefully aren't coughing and sneezing, Marin, a couple of points and questions about dairy RP. One congressional staffer just sent me a message and said they do not believe USDA can open dairy margin coverage without Congress. But of course, we could go to the courts and argue that as well. So that's at least their interpretation, Marin. Second, I think to clarify, there's a good question. You'd mentioned the DRP tool with their local farm credit. To be clear, I think, Marin, you were talking about there's a kind of analysis tool that Farm Credit has access to for dairy RP. However, dairy RP is available through many insurance agents, many of the same agents that sell crop and other insurance. So do you want to just clarify that tool versus what's available through?
Absolutely. DRP is available to everyone. There's a free market out there. There are many good brokers outside of Farm Credit, many of them that I appreciate tremendously, and you should just go wherever you can get the best service. If anything, I'm trying to be a little bit like Elon Musk here, create a better electric car to stimulate others to make electric cars. Not to make this about cars, but my hope is that if I make a really good tool, that I will also encourage others to improve their tools, because I do see that my analysis of the situation was that the farmers unfortunately did not have something that's very comprehensive. So anything that we can do to serve you in any way that works best for you. LGM is also a good tool. CME is always there for you as well. Forward contracts through your co-ops. My point is that you have to, well, I'm sort of like jumping to a point here, but you will see in a few slides what I'm really saying is the big shift in mentality that you need to have about revenue protection and risk management in general. So 22% of dairy producers said, or people on the call, not all of them are dairy producers, 22% said that they had some flu symptoms since January. I was also out of commission for about a week in late February, just coming back from Florida from an FC Stone conference. And, I thought it was Corona, but, who knows? I didn't get tested, and, who knows? Yeah. So anyway, to proceed with my slides, my point is that it would be foolish, maybe not foolish so much as dangerous, to be completely 100% confident that this is just an event that's going to blow over by summer and we will go back to roaring economy like we had just a few months ago. In history, when we had these disturbing major events, they often precipitated a new era. So I have here a newspaper excerpt from 1914, where in Sarajevo, one member of Serbian youth called, I believe, Black Hand, they shot the Austrian heir presumption, heir to Austrian throne. They shot it, and it started the ultimatum from Austria to Serbia, and then coalition forming, and we had World War I as a consequence. Even that summer, people weren't so sure that there will be a war, but for years prior to that, there were forces accumulating that were just waiting for a trigger, and then things unraveled. This virus that we are now experiencing may be a trigger to a new regime rather than just an isolated event that we will work through. So I take my advice on geopolitics. I read widely, but the analysts that I particularly favor is Peter Zion, who's out with a new book. I don't get any commissions for this, but I do want to be well informed. And he's now publishing also free newsletters almost daily on this. What Zion is saying is that we are entering a new regime anyway with respect to global trade and geopolitical regime, and that the virus may just precipitate us, fast forward, towards that new world faster. Why does this matter for you? This matters because it induces more uncertainty over a longer period of time. So whereas in normal times you would use the backwaters, you would wait, you would look for backwaters to give you at least a break-even protection before you pull the trigger on risk management. I believe that right now you need to look from a loss mitigation lens all the way out to third quarter 2021, which is the furthest out that you could currently go. Even if you don't have a break even there, I think that it's prudent to start putting in protection that far out. Maybe a dairy analogy would be better, or somewhat closer to home. Imagine if you have a beautiful, high-producing cow that just freshened, and then for some reason you're not able to milk her for 3 weeks. She will never again have that same peak milk per pound per day for as long as that lactation is going. You just don't recover from a shock like that overnight. It has long tail. It has a lingering effects. Even if we find a cure against the virus tomorrow, let's say that this new anti-malaria drug is proven safe and effective to use in a certain regime, etc. People have been out of work. They will get worried that they don't have enough precautionary savings going forward, that something else may happen. People will still worry whether they will contract something if they go to restaurants. It's not going to happen overnight. It's not. And this may also make companies worry more about the length of their supply chain, especially if they are getting parts from overseas. So it may propel us to reorganize our economy. And I don't know. Nobody knows for sure. But you use risk management not to protect against what you know, but to protect against what you don't know. And at times like this, we need to be humble and understand that there's more of what we don't know. To convert that now to an actionable mindset, even if the price far out is not something that fully covers your break even, you have to think. You should. I would, if I was in your shoes, I would be thinking about it from a loss mitigation perspective. Even if the price is lower than your break even, it's better than $10. I'm not saying that $10 will happen, but I'm also not saying that it's not going to happen. So,
Marin, one specific question here as we leave DRP, just briefly, I know we've covered this in other webinars, but class versus component pricing, do you have a 10-second answer on what a producer should do?
Class, if you can. Yeah, class, if you can. The people have been going towards class more and more. We tried very hard to make the class and components priced appropriately, but even if you set butterfat to 3.5 and protein to 3.0 so that it mimics class 3 as much as possible, it's still a few cents more expensive. That's just the quirkiness of the market. There's limited amount of data massaging that we can do on our end before we send the premiums to USDA. Or the materials for premiums to USDA. So it does still seem that the class is more favorable than components. But on the other hand, at least as of yesterday, class was not open for July, September 2021. Components were. Maybe if class was open, it would have been 2-3 cents cheaper. Forget about 2-3 cents. We have bigger problems right now. If you have a choice, class wouldn't be a bad choice. If you don't have a choice, you don't have a choice. Then the choice is whether you act on it or not. I don't want to say that components for July, September 2021 are a bad choice. That's what I'm trying not to say. trying to say. 85% of all milk covered through DRP is covered through class pricing option right now. Lucas, any other questions?
Yeah, since you just covered that, 85% is covered through class. How much DRP was taken in 2020 prior to the fall in prices? And also maybe as a comparison, how much milk is wrapped up in dairy margin coverage in 2020?
I believe that we crossed 20% on DRP. I haven't looked at the prices. Haven't looked at the sales data last few days, but I believe that we are over 20% nationwide with dairy RP. It should actually be much more than that. 20% is not enough, not nearly enough in times like this. With DMC, we did go down tremendously versus year before. So I think we might even be in single digits there. But again, I would need to follow up on that. I haven't looked at the data on DMC as closely recently.
And do you think government might buy cheese or dairy products for the food shelves through this kind of disaster?
I think they would be considering it. Yes. That's really a question that National Milk can answer much better than me. They're closer to the Secretary's office and their deliberations, but I believe that would be something that we are likely to see in days and months ahead. Okay, so I want to say a few more technical items. First, on dumped milk. Well, first, we all hope that it doesn't get to that. I know that cheese plants here in Minnesota and Wisconsin, some of them at least, are proactively hiring more staff in case they have some part of their labor force call in sick because of COVID-19, so that they want to hire more than they need in normal times so that they can rotate folks. But if it does come to that, if you do get a call from your creamery saying that, hey, we don't have a way to process your milk right now, please dump it on the farm, measure how much you dumped, report it to creamery, and even now, call your creamery and make sure that all the milk, that they have the systems, IT systems in place, so that any milk that may be dumped is reported on your paycheck, even if you don't get paid for it. The pounds should be included on your paycheck. You have a new poll?
Yeah, have you been told to cut back production? And as that's going through, Marin, since I thought it was relevant, before we leave dairy RP too far, somebody was wondering why Q3 of next year got open.
Why did not get open, or?
Let me reread. Why isn't Q3 of 2021 being opened up?
It is opened up on components for class. So there are a set of rules that measure whether there is enough information from CME that would make those prices be deemed as a reasonable outcome of a price discovery process. When those thresholds are met, then we send a signal to USDA that they can open sales on that particular day. We keep those rules under wraps. As a black box, I'm never revealing them, because if I were to reveal them, they would be easier to manipulate, and then we would have to make them more stringent. So they're black box because we care that you have sales as often as possible. So please trust me that they are reasonable. I guess that's the best I can offer there. And also keep in mind that unlike DMC, where you only have government on the other side of your contract, we have private companies involved with their revenue protection, private insurance companies. If we make this deal clearly unfair to them, clearly biased towards producers, they will bail out on us. There will be nobody that will be willing to assume your risk. So it's a delicate balance with creating a product that is as useful as possible to dairy producers, while at the same time being fully fair and transparent towards those that are assuming the risk that you're paying them to assume by paying premiums. Long story short, I hope it opens soon, but we need to see more activity on CME.
Yeah, I think carry on, Marin.
All right, so the dump milk, make sure that your milk is included on your milk check. Per crop insurance policy rules, only in order for you to demonstrate that you have that you are eligible for full amount of indemnity that would otherwise be due to you, you have to say that you have indeed marketed at least as much as 85% of what you have declared on the DRP policy. So if you end up dumping 20% of your milk over a course of a quarter, that's extremely unlikely event. But hey, 3 months ago, it was extremely unlikely that Dow Jones will go down, 30%. So if that were to happen, the only way you get the full indemnity is if you can provide the paycheck to your insurance agency and say, I did market that milk. I didn't get paid for it because it was dumped, but that milk should be treated as marketed. Also, I corresponded with NAS was it yesterday or 2 days ago, and they told me this. As far as the milk production report goes, if dumped milk is reported to the Federal Order Office, Market Administrator's Office, like in our all our federal orders, then they will count it as milk produced. So when we calculate the quarterly milk per cow, which is milk production divided by number of cows, the dumped milk, if it's reported to federal orders, will be counted as produced. So it would be really terrible if that milk gets counted as produced for the purpose of setting the milk per cow or the yield, but you don't have it on your milk check, and therefore it's treated as you never produced it. That's not something that I want to see happen. So please talk to your creameries. They have to have IT systems in place so that any dumped milk does get reported on your milk check. That's my point there. And then the last part we actually already covered. As far as I know, the latest is that there's no updates to the DMC production history. Unclear if the sign-up will be reopened. You just heard, from people that are closer to the kitchen than me that there's not, that looks like you can't cook it up. To torture that metaphor. But there will be money available for intervention purchases of dairy commodities. Again, these are bad times. Think further out. Have loss mitigation mindset, and if you don't get paid on whatever risk management strategy you end up using, whether it's LGM or CME or DRP or forwards, give thanks, because that means that we are out of this crisis sooner than markets thought we would be. I'm going to leave it at that and then open for questions. I have a bunch more slides on all kinds of stuff on what's happening in the dairy economy. I really don't want to muddy the message here too much relative to what I've said before. I think that perhaps just one other point here is that when I talked about this virus maybe inducing a structural change, China is currently looking well with the virus, but China has a number of other structural issues. And if the global economy tanks and they don't have enough exports, this may be a needle that bursts the bubble of their finance system. That is all about. They've been in permanent stimulus last 10 years. They've been overstimulated, if you will. And I wonder, whether this would be the straw that breaks the camel back there, which would not be good for us in terms of dairy exports. Lucas, back to you to see if there are any questions that I may answer. I have a few more slides on how DRP is used, but again, I don't want to overwhelm people with too much information. I'd much rather them to take 1 or 2 key messages and then implement them than like 15 that are just forgotten.
Yeah, thanks, Marin. One of the first things on a logistics, we will be sending out an email at noon tomorrow. You'll see it from a Minnesota Milk email address. So we will have the recording and slides at noon tomorrow out. So a lot of people have been asking about that. So glad you're finding this valuable. Second, for Minnesota and lots of other states, getting lots of text messages, emails about shelter in place And just so you know, I mean, shelter in place is obviously a very serious thing and is akin back to bombings years before. But shelter in place, as long as your state follows the CISA guidance, agriculture has very good kind of, I don't want to say leniency, but noted as essential very well through there. We are recommending to people to give themselves and employees pieces of paper that they can self-certify. We have that on our website that they're essential, but this is not martial law. You know, law enforcement should be suggesting that you go somewhere else if you're in a group or on the road for no reason. But as an essential service, you would be in good shape, and there should be no legal precedent to say stay off the road, especially doing essential work, especially raising livestock. Tom asks Marin. Oh, by the way, on our last poll, 81% said no, they hadn't been told to cut back, and 19% said yes, they had been told to cut back production. And so I guess related to that, I'm going to skip Tom and Steve's question, but Reed asked, how likely will there be supply disruptions like dumped milk on farms and plants shut down?
Yeah, I hope it doesn't get to that. I think we have a very robust infrastructure. In all our plants are cleaned multiple times a day, and there's anybody who has ever been in a dairy farm knows that you do keep distance from other people, and you do wear all kinds of personal protective equipment if you're dealing with food. Virus is not spread through food packaging. Pasteurization does kill any kind of pathogens in milk. So there are ways that that we can avoid shutting down the plant, even if one or two employees does call in sick and they're not able to get to work. It's not like we have to send everyone to isolation. So I hope it doesn't get to that. I think that at this point I would put it in a category of which I don't expect to happen, but I cannot rule them out, and I would deem them sufficiently severe disruptors if they do happen, that we need to act now to get ourselves ready how to handle that situation if it does happen, even if it's highly unlikely. And many people have spoken with you on different aspects of how you can get prepared. I just wanted to focus today on making sure that your risk management program doesn't suffer because of that.
Thank you.
Not likely.
Question. Exports, we're getting questions. Are exports bogged down due to a lack of port space, or what's the situation on exports overall, Marin?
Unfortunately, exports is one of those elements of supply and demand table that we get with most lag relative to others. So here we are, already looking at retail sales that happened just 10 days ago, but export numbers are typically much delayed beyond that. I did not have a chance to visit with our major exporters over phone to see what happened to their orders recently, but we do see that global prices for powders and butter are declining, and that's indicative of our class 4 price follows very much what's happening in the world market, and particularly the non-fat dry milk price, which has been going down for almost 3 months now. So I can't answer that question with the level of detail that I would myself find satisfactory, not at this point. But we'll look into that and follow up as appropriate, either through Minnesota Milk Minute or other means.
Yeah, thank you, Marin. So we'll get back to the DRP and DMC questions in a second, but one more kind of general question from Roxanne. Class 1 utilization has increased, obviously, as you showed on the early slide. What does that have as an effect on the milk price? Is that going to overcome what we're seeing elsewhere in restaurants, for example, Marin?
I don't think that it's going to overcompensate. I don't think that when you put together the effect that class 1 higher utilization will have on your milk check versus other things that are happening right now, I don't think that the class 1 wins the day. Class 1 may increase what we call producer price differential a little bit, but we will know much more in the next few weeks whether remember where we were just a week and a half ago. It's like, oh my God, the world is falling. Like, we'll run out of toilet paper. There were, and other items, right? So people went and stocked up. We don't know yet whether that's a permanent increase in demand or just a one-off blip, and now people are realizing, okay, we are under shutdown, under lockdown, but groceries shelves are being restocked. The new products are being distributed to our local stores, and I can keep my children fed, so I don't have to stock up on it and freeze milk. So we don't know yet how persistent that demand shock, a positive demand shock, will be. I would expect the overall effect, unfortunately, to be on the negative side rather than positive. People that have lost their jobs, and they will now fall back to uninsurance benefits, which will be higher than in normal times, and that will help. But still, they will have to cut back, and they will have to cut back on items that are more luxurious, if you will. So maybe rather than ordering in some ready-made meal that has a lot of dairy, they will be cooking at home. And like I think that may mean, I'm concerned that may mean that the dairy content of their meals will be lower. So overall impact, I do think, will be on the negative side for the milk checks, despite the increase in retail sales and in particular Class 1 sales.
Thanks. So back to Dairy RP, Tom asked a couple of questions. I think these are the same question, Tom, but send again if they're not. Will they ever consider adjusting Dairy RP to an average of 2 months or even on a monthly closeout? Is that a possibility down the road?
It's always a possibility, but I would advocate against it. Like CME is there for a monthly sales, and 2 month sales is not that much different than a monthly sales. Quarterly sales does allow us to cover all 50 states in terms of production shocks. If this was just a price insurance and not a revenue insurance, the subsidies would not be as high as they are right now. The program would be put in jeopardy if we go down that path. So I'm personally not in favor of that. And certainly we don't want to see. We understand that there may be some rearrangement of how people use CME now that they have these other tools available in their mix as well. Volume has been going up, for example, on CME, but we don't want to, and it's not fair to the taxpayers, to be honest. Like my opinion, it's not fair to the taxpayers to just create a product that closely resembles something that you can buy in a private market and then just subsidize it. Like that's not what America is about. So the answer is no. If I can help it, no.
And so if you're going in today to lock in some DRP contract, Marin Bozic's dairy, what percentage of your total milk would you sign up for Dairy RP?
Sure. I would probably go 50% of my milk with protection factor 1.5 in 2021. That gives me the ability to have some maneuvering space as we approach 2021. So if I do see that there is an opportunity to lock in additional profit, I'm not fully covered, and because I use the protection factor, I still have 50% of my milk to cover if the prices prove out to be good. If the prices tank down, then I have 75% of my effective pounds covered. 50 times 1.5 is 75%. So I'll probably go half in all the way out right now, and then keep a very close pulse on the economy. And July 1, fourth quarter of 2021 will open, assuming that there's enough activity. I would jump on it, I would act on it swiftly.
Jim has a question here. If you signed up for dairy margin coverage for all 5 years, will it be available? It might have just been a way you or I phrased something, Marin. He says, your comment states unclear if you can sign up for 2020. Jim, I think it's just too late to sign up for 2020 at this point. But what Marin, I think, was talking about is they could reopen it up and kind of go backwards. I don't know if there's any other words to say on that, Marin.
Well, no, I mean so here that's sort of the vicious cycle, right, with DMC. the more frequently you reopen it after the fact, the more people start anticipating that if anything really happens that will trigger indemnities, that you will just reopen it. And then we are calling it risk management. It's really just income loss, support, and and it's not really making a difference. It's not a proactive risk management. It's sort of, we call it risk management because it's politically correct. So I'm okay with it being closed, in December as opposed to September for the year ahead. But we have to understand that even with that, and with the way the government has behaved in the last few years, people are going to be almost either all in or all out, depending on what the forecast is for the year ahead. And that's the way that it is right now. I think that we should consider increasing the production history. I think that makes sense. But let's keep it risk management. Like if it's risk management, it's risk management. Like it's subsidized, fine, but let's keep it risk management. Like a year ahead, ends December 31. And
I put up a new poll for those of you who are maybe on the phone only, but the poll is my biggest fear with COVID-19 and milk prices crash, losing employees, local milk plant goes down, or I expect little effect, and we've got 40% of the votes in. We'll leave that open a little longer. George is wondering, Marin, about your opinion on a hard contract nearby or in nearby months versus dairy RP. What's a better buy for you?
I guess I don't understand the question. What's the alternative? A DRP or what?
A hard contract nearby months. I'm guessing what George is saying is, just forward contracting, but I don't quite know.
Yeah. Well, like the options are never the best choice looking backwards, right? If the price went up, you would say, well, I should have done nothing. If the price went down, you would say, well, I should have just locked in, do a hard contract, right? Because with any options, you always have that 5% drop. Like if the price is $15, let's say, and that's 5% is 75 cents. So the price has to fall 75 cents, and then it has to fall another. Let's say that the premium is 10 cents. The nearby month, so it has to fall 85 cents before you see any dime out of any penny out of that. With a forward contract, if it drops $1, if it drops a cent, you get a cent, right? Maybe you have to pay the fee to your creamery for a forward contract, that can run 10 cents or so. So if you're really concerned about the downside and you're willing to forgo the upside, then yes, forward contract would seem to be a better deal for you. It's about minimizing your regret, right? So try to run a few scenarios in your head or with a tool if you have if your provider offers you a tool. So you run a few scenarios, like what happens if the price goes down by $1. See how you feel under DRP, how you feel under futures or forwards, and then do the same scenario if we suddenly have a recovery, and it goes $1 higher. You need one or the other. You'll feel sore about some of the decisions, right? And you just have to see what hurts you more and avoid doing that which hurts you more. People are different. Everybody's different. Their liquidity positions are different. Their ability to ride out bad times are different. But here's what I'll say about all of that. You don't optimize your feed for your cows every day, do you? You don't make radical changes day by day because that badly affects their production. You want to keep it somewhat steady, right? Of course, you optimize. You look what's available, but you want to keep it steady. Micromanaging your risk management strategy is probably why right now you have a loss. Because if you put it on autopilot, if you had used the strategy that like I've been shouting from the rooftops for the last 5 years of using distant contracts, right now you would be in the money for most of 2020. And because you knew better, because you knew it's not like what you don't know that kills you. It's what you know for sure that just won't happen, and then it does happen. So the best strategy for risk management is humbleness. that the world is such a complex place that no matter how well you understand supply and demand and what New Zealand is doing and what Europe is doing and what's happening with butter and what's happening there, that there will be something out there that will come from from your blind angle and hit you. So if you keep it simple, it will be effective. And yes, I mean, if you think that you really know better than the market, go all in. I mean, I'm not saying it's impossible. My wife has been short S&P 500 for a few weeks now. She's been smiling all the way to the crisis here. My pension she put in a fixed interest rate fund that we have available through university. So like some people just see it better than others, and if you're one of them, go for it. Like it's your strong suit and play it. But in general, like the default position should be just keep it simple. Understand that you won't get the peak. It's very hard to be consistently wrong either. If you know the core principles of effective risk management, you'll get, if not 100% there, you'll get 90% of what the best strategy would be over the long term, or the long run. I really don't mean to sound as if I'm pontificating. I'm giving you the same advice that I would give my brother or a father or a son if they were in dairy. That's my honest, heartfelt, the best I can do to help you, is to tell you, keep it simple, hedge distant months, think about, in times like this, think about even distant months from a loss mitigation perspective.
Great. Next one, back to dairy RP, would you go all class 3 or a portion of class 4 if you're located in order?
Which order?
30.
I would go maybe 20% class 4, 10 to 20% class 4. And there is a debate, a legitimate debate, whether you should do it on a single endorsement where you choose 80% class 3, 20% class 4, or two different endorsements. On one, when you do class 3, the other one class 4. It all depends on whether you believe that which one, but you will pay a little more if you do two separate endorsements than if you do just one. But they will pay out a little bit more frequently, and so that's the trade-off that you have to decide for yourself there. I would personally be indifferent between choosing individual or just one endorsement with mix of 3 and 4. So I would go maybe 10 to 20% class 4.
And here's a big picture one, Marin. Do you see the pricing situation leading to more consolidation on the production side in dairy?
So we have been on a higher consolidation trend for a number of years, last few years here, and I actually have some slides on that. Let's see if this one from current slide. It's not. Give me just a second, Lucas. I'm trying to see if I can.
And related to that, as you're answering that one, very related, are we going to see a drop in production as a result of all this? Are we going to see an overall drop in U.S. or worldwide production? Maybe one of those questions leads into the other.
Yeah. So okay. So let me answer one at a time. First, the consolidation and the impact on dairy. So this is what 2019 Wisconsin looked like. The red line here. And you compare that exit rate relative to what has been happening since the 60s. This is not normal times. Many more dairies have been exiting than they do in a regular year. And how will the U.S. dairy look like in 2030, depending on the pace of consolidation? I don't think we're in a 3% territory anymore. I think we're closer to 7% than we are to 3%, and that is an increase versus historic rate. It does depend to some extent on what your opportunity costs are. Like if you're just graduating, if there are no jobs out there and your family has a dairy, well, maybe you want to stay on the dairy, right? If the economy is booming and there are plentiful jobs, maybe then you pursue a different career. You serve agriculture, as a sales rep somewhere, or in some other capacity. Also DMC is a game changer. I think that it's going to stop the bleeding, at least for those dairies that are using it. Will to a good extent stop the bleeding versus what happened in the last few years. And I am concerned about dairies that are not using risk management unless they're really well financed and well high liquidity, high solvency, repayment capacity. Because the big guys are using DRP more and more, and the small small and the big question marks up. Those farms up to 200 cows are very well protected through DMC. If you're in the middle and you haven't pulled the trigger on risk management, well, guess what? You'll be the one balancing supply and demand. The second question was on milk production, whether it will go down. Here's what we do know that's different today than 10 years ago. Supply chain is getting more coordinated. So all of the signals from demand to quantity produced 10 years ago would be through price. Co-ops would be saying, well, just take whatever milk you produce. There was spare capacity. And then the price had to drop down $10 and it really hit you in the head, for some people to stop milking cows and exit the sector. Basically, we had to bankrupt a number of dairies to balance the market. Nowadays, we have base programs and from coast to coast, really. Like more and more co-ops and more processors are moving to some type of tiered procurement contract when they promise that they'll take a certain quantity, but anything above that they can pull back or penalize you if you delivered more than that, etc. What that means is that in a time when you have a severe demand shock like we have right now, they can activate those programs and they can provide marginal incentives that are severe enough to incentivize lower production without dropping the market price as severely as it would otherwise need to be. So it's difficult to me to answer whether the overall production will go down, but certainly we will see a much quicker production response to demand shock than we would see if we were only transmitting those signals through price. So I would see a slowdown, yes. Whether it gets to a point that it shrinks, so in the negative territory, then that I would need to look in deeper into those numbers before answering that question.
Thank you, Marin. Do you watch much on the beef side? And if we do have that shrink in production, that means cull cows. Do you see dairy cull cows having a major effect on beef? And we've seen a lot of chatter in the beef markets the past couple of weeks.
Yeah, no, that's an issue. Again, one of those issues that would probably be better if we address through one of the forthcoming Minnesota Milk Minutes than today on the webinar. I don't feel that I have a solid enough grasp of the situation to offer more than just academic babble at this point, and I don't want to do that. I want to stay expert in as little as what I know, rather than claim I understand everything in the world.
All right. Thank you for that. For those not knowing, the Minnesota Milk Minute is a Friday e-newsletter that we send out. You can all subscribe to it by responding to the email you'll get tomorrow. Our sister trade associations and I-29 Move You all have their own e-newsletters if you'd prefer those states as well. That's Iowa, South Dakota, and Nebraska, as well as I-29 Move You extension. Here's a kind of more specific product side question. Marin, why is it hard to find whole milk in the stores? Is it going to powder that will be exported, or is it a processing issue? And this, Carrie's asking this. It may be before and after COVID-19. Any thoughts on why we're seeing whole milk shortages?
I'm not sure that there's anything about our supply chain that would that would make that a persistent issue going forward. If there is demand for it, there will be supply. It will be supplied. One thing to keep in mind, and I was actually surprised that not many people actually understand this, that one of the functions of the federal milk marketing orders is to make darn sure that there is always a secure and ample supply of fresh milk in the stores. So what does that mean? That means that if there is a rush in a retail store and milk is flying off the shelves, and a retailer calls the wholesaler or the distributing plant and say, well, we need more milk, and the bottling plant then calls a co-op or someone else where they buy milk. If that supplier of raw milk is pulled on the order, they have to respond immediately. They have to send as many trucks to the fluid plant as is requested. The fluid milk plants are the only ones that have to pull, but they have the right to call and be delivered as much milk as they need immediately. So what is the practical implication of that? Spot market for milk, which trades typically below class this part of the year, has been strengthening because there's some spot trading of raw milk happening. There's not a central market like CME for that, so that basis has been going up. I just heard yesterday that in Pacific Northwest, it was trading up to $7 below class, and now it's above class. So what that means is that the spot market has tightened there, but anything else takes a lower priority over serving fluid milk plants. If you're a supplier and you have pre-committed orders for making cheddar or some other products, and you're pulled on the order, and you're the only one that can serve a fluid milk plant, and they call you, you know what? Tough luck with your orders. You have to serve that fluid milk plant. That's why any stockouts in retail stores on fresh milk will be very, very, very quickly taken care of. And if there is more demand for whole milk, it will be served. In fact, through the last few years, the only category of fluid milk that has been growing is whole milk. And up until recently, they struggled a little bit last year, but certainly less than other categories. I don't see any structural issues that would make that a persistent problem in the supply chain.
Thank you, Marin. One question. I'll close this most recent poll here and show the results. As you can see, almost half of our people either are not affected or have put off an investment, but 15%, it's made them speed it up to get ready for the future. Always interesting. But somebody's requesting that you can list the dairy farms or the percentage of milk with some dairy RP coverage across the country again. Can you recall that knowledge, those stats again?
So how much are different regions covered with DRP?
Well, it's just how many farms or what percentage of milk have some DRP coverage across the country.
So I believe about 3,000 to 4,000 dairy producers. No, I may have said it wrong. Like a few thousand dairy producers have some coverage. That's out of 30,000+. So distinct minority still. I think that overall percent of milk covered is about 20-ish%. In Minnesota, I think it's over a quarter now. In South Dakota, it's I think over half of the milk. But in Northeast, for example, it's very low. It's much lower, and Southeast is quite low. As in Western states tend to be a little bit on higher utilization there. I should make a map and share it with you, Lucas, so we can send it out with a newsletter.
Okay, yeah, that'd be great. And Jaime was thinking that we maybe could have answered the dairy margin coverage question a little better before. I'm trying to see who asked it, but basically just to clarify, if we would quote unquote reopen dairy margin coverage for 2020, that would be for the 10,000 people who didn't sign up. That wouldn't be for everybody, so to speak. That would just be for those who aren't covered. So we maybe weren't clear on that before.
Can we give a mic to Jaime, and maybe he can just brief everybody up on the most recent developments from today, like if I didn't cover anything properly. Certainly he's more informed than me on this. Jaime, do you want to say a few words?
We'll get through these last three questions here, Marin, and then Morgan, if you would find Jaime Castaneda and see if he wants to say anything, but if he's available. Alan is wondering, on the insurer's side, is the quarterly tool your way of hedging the insurance without taking a CME position?
I guess I don't quite understand the question, but let me try to rephrase this. Perhaps one can ask, if I'm using DRP, do I still need to use CME? And that's individual decision. DRP leverages the price discovery function of CME to enable you to take coverage even in those months where liquidity on CME does not allow many producers to do so. So prices for 2021 on CME are useful as an indicator of what the current market consensus is. But if we try to cover 5 billion pounds in the third quarter of 2021 through CME, it would be difficult. So the purpose of DRP is to first leverage that price discovery from CME and offer more. And then what's really important that it also covers production risk, which is something that CME does not do. This is not designed to be just CME on steroids. It's also designed to cover risks that you don't cover elsewhere. And I know people will say, well, yeah, milk per cow, it's not a big deal. Yeah, it's not a big deal until it is a big deal, right? The Dow Jones wasn't a big deal until it fell 30%. Now, it's not an event that happens frequently, but if it ever does happen, we'll be there. And DRP will be there. So, and that's not something that other tools other programs can offer. People have been finding interesting ways to combine DRP with CME rather than abandon CME. So if you're inclined to think through marketing programs in a really sophisticated ways, that I don't really want to now overwhelm everyone with that here, but there are good brokers out there, so people that understand the CME as well as DRP, and they can help you do that in a meaningful way.
Thank you. So we got one more question. Feel free to send more in if you have more questions. And I think we have Jaime's mic open if he is available. We didn't warn him about this, so not sure if he will be available. But the last question, Marin, is larger farms, can they withstand this lower pricing longer?
No, not necessarily. It all depends on how leveraged they are and what last 4 years have done to their balance sheets. Some of them are very fragile. Last part of 2019 was good, so it took off a little bit of pain, but not necessarily so. They tend to be more efficient. That doesn't mean that all of them are, and they tend to provide higher returns to capital, which is why the share of milk produced by large dairies is growing. Maybe I can show a chart here. So here's something else that recently made that shows how many cows overall we have on dairies that have more than 1,000 cows. So 20 years ago, well, 23 years ago, 1997, we just had 1.5 million out of 9 million cows. 1.5 million were on dairies that have 1,000 cows in one location or more. We now have over 5 million cows on those type of dairies. Well, that tells you something about who's profitable, right? But the profitable and robust are not the same things. So I think it's on a case-by-case basis. Jaime, are you available?
We have a couple more questions about the forms for, as your state goes into lockdown. Again, as we understand it, not technically needed by law, but I think it does help explain to your employees that they are critical and give some confidence to law enforcement in the rare case they would be pulled over. We would recommend giving them to everyone, mostly to educate employees and then also law enforcement if something would happen. Jaime, I don't know if you're there or have anything to add or dispute anything. We'd love to have more discussion, but we do not have any more questions at the time.
Can you hear me?
Hi, Jaime. How are you today?
I am fine. I'm fine. I'm probably better than most people, so I'm counting my blessings. And of course, I'm a big fan of you, Marin. So no, I just want to double check or or assure those folks that whoever has signed for DMC for the 5 years, I mean, they took the discounted premium. Those guys actually, whatever National Milk and others are asking for reopening, those guys have no problem. They have already, and they will be getting some payments in March. What I think we're asking is that obviously, and I don't disagree with you, Marin, when you say that this is a risk management, but obviously unique situations demand different types of actions. If this would have been a regular year, even if it's a low price regular year, we would not be asking to reopen. But this is very unique situation. So
yeah, I agree. I was commenting in general, but
but we hope that
yes,
we hope that the department will open. So I think that the total amount of farmers that sign up last year were about 24,000, more or less. So about half of that sign up for 5 years. So we're counting on that there are out there about 10,000 farms that didn't sign or more for the 950. So we hope that the department reopen because just by your calculations, Marin, the margin is going to be dropping probably. I think if we're lucky, we're dropping just around $8, which will give at least $1.50 to those farms.
Yeah. It won't fall as much as milk because feedstuffs and feed is also falling or will be falling. But yeah, it would be a good help. I think probably reopening it would put, what would you say, Jaime? Probably between $500 and $750 million in back to dairy farmers more if we reopen it in a year like this, if the recession continues for the rest of the year. So it's a big deal.
And of course, and we always say that we rather see the money coming from the market, but if the event that worst case scenario come through, that at least those can see maybe $1.50, $2 back to them.
Yeah.
So I think that I don't know if you have made the calculation. I think that we did calculate it that for the 5 million pounds at 950, the whatever premium you need to pay will be more than offset with returns.
Yeah. Absolutely. No, that's a sure thing. Like given where we are.
And that, of course, doesn't take away from anything else that farms can do. I mean, and whether it's DRP or LGM or forward contract or something through their co-ops, whatever possible, to manage the loss.
Yeah. I was on a webinar with National Milk and State Associations, was it yesterday or 2 days ago, and impressed with everything that the organization is doing. And on behalf of people here on the webinar, thank you for the work you do and the leadership you provide in these difficult times.
Yeah, thanks Jaime for jumping on, and we did I think mute him again because there was feedback when I was talking. So Jaime,
that never happens with Jaime.
Jaime, text me if you need to get back on and respond. But we do have another question, and it's more of a policy question, but I'll ask you as an economist first, Marin. Wouldn't it be better to promote a program that everyone could take advantage of rather than incentivizing people that made a poor choice by not participating in dairy margin coverage? And I guess before we go there, I got another question. I should have further introduced Jaime Castaneda. He does lots of different things for National Milk, involved in all sorts of different areas from labor to economics to really all the fun, controversial stuff is what Jaime does for National Milk. So a good friend of ours. But Marin, any discussion on would it be better to have a program that everyone could take advantage of than reopening this up from an economist point of view?
Right. So we live in a republic, not in a some kind of system where bureaucrats are PhDs and they get to make the decision based on mathematical models, and God forbid we ever get there. In a republic, we decide what's better through these late night negotiations, like we've had last night, through turmoil, through filibusters, it's a sausage making process. It can get ugly. It's the best we know how to reconcile conflicting interests and still keep our freedoms in place. My role in the ecosystem is to offer insights on the consequences of decisions taken, both short-term and long-term, to the best of my ability. So the reason, for example, why I got involved with dairy revenue protection is because my research was showing that, I'm going to say a few big words now, when milk prices are mean reverting, that the optimal hedging horizon is longer. I'm still working on publishing that paper, but here we are, 30 billion pounds already covered because of that insight. So my role is to develop insights, and then, where I see a gap in the market, also develop decision support tools that hopefully elevate everybody forward, and including those that are making similar tools. Maybe they can see from me something they haven't thought about, and they can make even better. So competition and evolution is what makes everybody better. I tend to stay clear from saying that something is better than the other, because that's what we have the Congress for. That's what we have that's why we have elections. That's why we vote for people that represent us, etc. Otherwise it gets complicated. You don't want one person out there just because he spent 10 years staring at his screens and math models telling you how you should live your lives. If anything, rather than focus on that issue, I think that we should be focusing right now on making sure that this transformation of society that's currently happening overnight does not leave us with permanently less freedoms going forward. Imagine if we were now living in China or elsewhere. Imagine if we had a totalitarian government in power. This would be a wonderful excuse for them to put all kinds of thermal cameras everywhere and track whether you're leaving your self-isolation because they put a GPS tracker on your ankle or through your phone, etc. Like that, they can do so much good if you just use the technology, except you lose your freedom in the process, right? So let's cherish the freedom, even if it's messy. I lived for the first 10 years of my life in a communist regime, and I'm painfully aware of the alternatives.
Lucas, Marin, this is Jaime again. Just want to make sure that I understand the last question about it, and I understand that also DMC doesn't protect everybody in the same way. But one of the many other things that we're asking is for purchase products, and probably Marin can opine as to how much the department could actually or should be buying cheese in order to make a difference. So we don't know. There's going to be this money under this third package that is going to be for livestock, including dairy. We don't know how much money is going to be provided for specifically for dairy, but we assume that purchases are going to be part of it. I don't know if it's going to be significant amounts that then will be stored in private storages or public, but I mean that's something that it will help everybody the same.
Yeah, no, that's true. That's true. Yeah, and we can follow up offline, Jaime, if you need any help on estimating those effects.
Yeah. Well, and this may be a webinar in itself, just a Q&A with our friends at National Milk. Marin, two things. One, the RMA report generator, according to Jay at Penn State, Jay Williams, he says 4,007 dairy farms filled out paperwork, 2,074 made a purchase decision in 2020. So that's his understanding. Jim Takla It says he used DRP in December, using Class 4 July. Class 4 has dropped $4. Class 3 has dropped $2 for the July contracts. Is Class 4 not more advantageous?
Yeah. Well, in this particular situation, right? Yeah. So it is. Yeah. Good job. Yeah. Nice. There'll be a nice indemnity check coming your way. I wish it wasn't, right? We wish that it went up, not down. But if we had to have the crisis that we are having, then nice job on covering your downside risk.
Donald asks, are we in an environment where it'd be best to put a floor under our milk price and not commit to a fixed feed price?
So corn already dropped, like what, 40, 50 cents? How much more can it go down? Keep in mind that, feedstuffs can get stored. They typically don't go bad overnight. It's it depends on how much you expect they will drop further than they already are. Perhaps it would be interesting to see how expensive are out of money puts for corn now versus 4 weeks ago. Why do I say that? Because that's typically what economists use as a measure of market consensus regarding the downside risk. And if indeed market is currently expecting that there's more upside potential for feed prices than downside risk, though for dairy it's the other way around. Like we like when they go down if you're buying them. Then depending on where that market consensus is, maybe you can use that to make an informed decision about it. But that's in general, futures today are the best predictor of what futures are going to be 3 months from now. Like for the same contract month. It's difficult to consistently be right about guessing which direction they're going to go there. And it also depends on what your feed situation is. A lot of people have locked in feeds for extended period of time. So what happens on the spot market doesn't matter for them. But if you are buying hand to mouth, then including that in your risk management system makes more sense, because any reduction in indemnity that you would get from a margin-based product is going to be compensated for by the lower cash outlays on the feeds that you will have to purchase.
Sure. So Rumor, 2 more questions, Marin, if you don't mind, and then we'll probably cut it off no matter what. Is that all right?
Sure.
All right. Rumor is that 50 loads of milk went for fluid delivery. Based on your earlier comments, this was about 20 minutes ago. Are you saying that's impossible, that 50 would have gotten diverted to fluid?
Is this for Minnesota?
Yes.
Why would that be impossible? No, I don't think it's impossible. I don't think it's impossible. What was the other week? Like you told me it was what, 28 loads last weekend, like when we talked about it.
Yeah.
Yeah. So why would this be impossible? Like that? I mean, I'm not privy to the facts, but I think that we are still in the restocking mode and the higher demand mode. Keep in mind we don't have shelter in place yet in many places, and people may be concerned that as virus spreads, that they may be even told not to leave the house. Like more than in France, if you want to go buy groceries in France, you have to write a written note, sign it, show it to the cops on the streets that you're going grocery shopping. What I'm trying to say is that if people are afraid that going grocery shopping next week is going to be more difficult than today, then even if they believe that shelves can be quickly restocked, they will still build home inventory, even if they haven't started yet. And people do react to headline news more than epidemiological models. So as we start seeing deaths in U.S. today cross 500, that's a headline that's going to scare people, and I wouldn't be surprised if they continue building up home inventory. So from that perspective, extra loads going to fluid even today is completely consistent, with the model that, with the mental model that I just outlined here.
Awesome. And last one, and we'll let you get a nap or something. Kent is wondering, isn't our BEST program making sure milk is available to the public through anything that happens, aka is the best policy to make sure milk is reliably always there?
Yeah, of course it is. Like, nobody's saying that we should induce any kind of shortages, or anything like that. In fact, in China, the nutritionists and the dairy industry came together and they issued a proclamation that people should be eating more milk during the coronavirus outbreak because that strengthens their immune system, so they can fight off viruses more effectively. So I'm not saying that we should exploit the situation, but we should continue doing what we always do. That is, make safe product, make it widely available at a price that's reasonable for all people that we serve, from a single mom to to an entrepreneur, and then promote it. Promote it based on facts and with truth and facts, but promote it very assertively, and not be ashamed of who we are and what we do. Be proud of that. I think it's time to wrap up this webinar. I just want to say I wish to all of you, and I know a number of you on the call here, but there are a number of names that I don't recognize. I wish all of you to stay healthy, that your families stay healthy, and give thanks for all the blessings that we do have. Even in situations as difficult as we face today. And also, if you want to reach out, if I can be of any help, you have my email, either through university or you can contact Lucas and he can relay the message to me. I'm also on Twitter at Marin Bozic, so I'll try to answer there and provide any data that I have. If I don't know something, I'm going to tell you I don't know. I'm not ashamed that I don't know good answers for many things that you're interested in, but for a few key things that we covered here today, I think that I provided you with solid guidance that can make a difference if you follow. Lucas, back to you.
Thank you, Dr. Bozic, and thanks. We've still got over 200 people on. Hope this was of value.